Hey guys, it's Tim, the economic forecaster, and today is June 17th of 2009. Now, there's something that's not right with the bond market. I've been noticing this over the past few days. We have been seeing a flight to treasuries over the past few days. It started after the auction of the 30-year bond last week. It seems that there was quite a bit of interest from foreign investors, and the 30-year auction went rather well. I don't believe it has anything to do with confidence being restored in U.S. debt. Why would people be buying treasuries if they thought rates would continue to rise? If you watched my video on how the bond market works, I explained that as treasury bond rates fall, the value of your bond goes up, and as rates rise, the value of your bond goes down. I think people have figured out that quantitative easing has failed, and they're betting that bond rates will fall. This is what we've been seeing over the past few days. The Fed trying to manipulate the bond market can be dangerous because it is bigger and tougher than any government or institution. If the Fed can't stop interest rates from rising, it leaves them with only one option: to crash the stock market and scare money back into treasuries. How do they do that? They pull the plug on liquidity, just like they did back in September of last year. You see, tomorrow we have a TAF auction. Under the Term Auction Facility, TAF, the Federal Reserve will auction term funds to depository institutions. All depository institutions that are eligible to borrow under the primary credit program will be eligible to participate in TAF auctions. The Fed has resorted to auctioning credit because there is a stigma associated with borrowing directly from the Federal Reserve, because the Fed is the lender of last resort. The first resort is depositors. When you deposit money with your bank, it lends it to someone who is going to pay the loan back with interest. That is how you get paid interest on your deposit. The second resort is the federal funds market. In this market, banks lend money to each other, either overnight or for 3 months, to cover reserve requirements. Having to borrow from the Fed through the discount window implies that banks cannot raise capital in the federal funds market. The stigma is usually appropriate because when banks cannot raise capital from other banks, it implies that they are in serious trouble, and lending banks don't want to make any loans that cannot be paid back. A credit auction is really only symbolically different from discount window borrowing. Banks are going to the Fed and bidding on credit that they want, rather than going to the Fed hat in hand begging for credit that they need. In either case, banks are borrowing from the Fed. So, if Bernanke pulls the plug and takes this liquidity away from the banks, we will start to see a repeat of last September all over again. It looks like the bond market is expecting this to happen due to the move in treasury rates over the past few days. We will know by early next week how this will all play out. The idea of reinflating the economy was failing. The government was trying to finance too much debt, and the bond market reacted by demanding higher interest rates on treasuries. So where does this leave us? Preparing for another cycle of deflation. Crashing the stock market and chasing money back into treasuries is the government's only hope for kicking the can down the road a little farther. They better hope it works. If stocks crash and treasury rates rise, we're in big trouble. Prepare for the worst. Thanks for watching. I look forward to your comments.